Today, we're going through a company that's been in the news headlines for all the wrong reasons. It's 40% down from all-time highs, and my first response to this company in crisis is to load up the boat and buy a heap of shares. We're going to go through whether that's been a smart or a dumb decision and what the future of UnitedHealth Group looks like. I did want to announce here on this channel that I'm going to be launching a portfolio that I'm going to put in around $200 to $300 in per week, and we're going to track the progress of it through Seeking Alpha. So today is the first day of starting the portfolio, and the first stock I'm buying is UnitedHealth Group, which might show you my bias in today's video in a sense, but it is a company I do own in a different portfolio, of course. One share is not all I own, but we're going to go through the crisis that UnitedHealth has been through in the last really 6 months. And we're going to go through all of this in relation to its price chart. As you can see here on the screen, the story really begins in October, November 2024, the last time UnitedHealth Group hit all-time highs. Things were looking pretty good, but there were some rumors throughout the health insurance industry that a lot of people were going and making more insurance claims compared to the last few years, and everything seemed fine until the 4th of December, and that's when the CEO was ended in the street, and that led to a 10% sell-off in the stock straight away as UnitedHealth's name was going through pretty much the worldwide news as an unfair player in the health industry, taking too many funds from people, charging too much for insurance, and not giving people coverage for potentially deadly illnesses, deadly procedures. At the same time this was all happening, we have the DOJ announcing that they were looking into United about overcharging Medicare customers, and altogether putting those two bad events one after another, we had a 20% sell-off from all-time highs going into late February of this year. And the next round of selling in the stock happened when they reported earnings on the 17th of April. And that's really where the skeletons were let out of the closet and shit really hit the fan. This statement came from the earnings report at UnitedHealth Group. Now, this highlighted an expectation for 2025 to see a decrease in profits per share of 25%. Now, usually as a health insurance company, UnitedHealth Group just seemed to make 10% higher growth in profits every single year, an extremely stable business model. So this is probably the first time since the GFC where UnitedHealth Group has seen such a cut to its earnings outlook. So it's really no surprise the stock dropped 33% following that April earnings report. And the company has stated that all of this is coming from really Medicare Advantage patients making more claim or having more claim activity compared to previous years. And the same goes for their Optum business, which is the second main area of the company. Now, Optum includes healthcare analytics and pharmacy, but also has some health insurance in there as well. Pretty much all of the issues surrounding the company, as stated by them, are coming from the health insurance part of the business. And that brings us to the last piece of bad news. We had about a 33% drop in the stock price from those really bad earnings expectations, that Q1 report, but the real cherry on top to bring it down to these insanely low valuations, and that is the CEO that was elected to take over the business after the previous one got assassinated. He came in for a period of, I think, about a month or two, and then all of a sudden overnight, with zero forecasting, he just came in and quit. And nobody really knows why he left, which creates a lot of uncertainty. Is there something about the DOJ investigation and he didn't want to go to jail? Is it something about the company's profits going downhill even more than what they said in that Q1 report? But Wall Street absolutely hates uncertainty. So the company actually sold off a further 30% after that CEO, or I'm calling him the interim CEO, after he left. And that's when the old CEO, his name is Stephen Hemsley, he's stepped in to finally take the reins and maybe bring an era of stability. But that's where I'm going to leave all the negative news in this video, and we can start to now build up the positive messaging about the company and look forward to the future. Let's begin by investigating the profit margin story at the company. And we're just going to look at the last report that came out, the one with the bad forecast about 2025. But the profit margin story actually looks pretty decent. From the business, we've got the major health insurance branch, just UnitedHealth Group, which makes up 57% of the revenue and about the same amount of profits. Their operating margin for that first quarter 2025, profit margins were 6.2%, whereas last year that was 5.8%. So things are actually looking pretty good for Q1. Well, let's look at the second major area of the business. What was that? About 43% of the revenue. So this looks like it's pretty much the exact same story. Decent operating margin, 6.1 compared to 5.8% last year. Same story. So all of this negative messaging about profit margins has not actually been shown in the business just yet. They're just saying at the end of Q1, we could already see the rest of the year looking quite negative, but there is no actual formal proof of that. And also from those two slides, there was a statement about the medical care expense ratio, or MCR. It's a really quick way for insurance companies to see how much money are they giving back to their customers. And if you flip that, it will give you the profitability rate of the company. So the medical care ratio for this year has jumped up to 84.8%, and that's up 0.5% compared to last year during the same quarter. So yes, we have seen that UnitedHealth Group is paying a little bit more out to customers, but again, nowhere near enough to match the negative messaging that started to come out. If we take all of the analyst expectations at face value, most of them are about the insurance side of the business. They still expect revenues to grow 12%. So if we merge the maths of a 12% revenue growth with a 25% reduction in earnings per share, that would mean that the profit margin of the business would be down 37%. And what we're going to do is assume all of those losses in margin are for the health insurance business. Every other sector, so products in other words, so that would be pharmacy, we're just going to assume stable margins. Now, is that exactly accurate compared to the real world? Nobody really knows, but what this does do is it helps us get a measuring stick. It helps us see the likelihood of this profit margin collapse. So what I've done is taken a screenshot from the earnings statement. Now this is from Q1 of this year. So overall we see the $73.4 billion that were paid out to customers, and they took in $86.5 billion of insurance premiums. Now what I'm going to show you on the left, just to give us a comparison, is what the premiums for the upcoming quarter are expected to be. Premiums revenue, about 86 billion, so almost the exact same. However, the profit margin needs to be reduced here by 37%. So that means the medical care ratio has to go from 84.8 to 90.4%. So that's the same as saying that medical costs are going to come out to $77.7 billion US dollars. So that's an equivalent of 4.3 billion extra dollars getting paid out next quarter compared to just the previous one. So do you think that's going to happen? Well, it's actually kind of hard to argue one way or the other. We need some historical evidence to help support our case. So what I did is I spent about half an hour going through all of the Q2 earnings statements from UnitedHealth Group from the last decade, and I've just plotted here for you guys the medical care ratio of the company. What I did is I took an average of every year excluding 2020 and also did a standard deviation. So the average came out to be 82.6%, and 68% of the time we see a 1.1% deviation from that 82.6% average. So what that allows us to do is measure the 90.4% medical care ratio that is currently getting priced in by analysts. The only issue with that is that's a 7 sigma or a 7 standard deviation above average measurement. Now, if we calculate that as a probability, this is a 1 in 1.6 trillion event. That's how unlikely this medical care ratio is. Just because something is unlikely does not make it impossible. A bit like the GFC, the first time that happened, 2008, that wasn't technically impossible. So what we're going to do is look at some recent history of other health insurance companies and what they've done in terms of their medical care ratio, their profits expected for 2025. Like UnitedHealth, which was known formerly as Anthem, they're one of the other major health insurers in America, and they really came out October of 2024 and admitted things are not looking great for 2025. So what I've got here is the profit projections of UnitedHealth, and what we can see here is a decent collapse, around a 15% cut to profits expected for 2025. If we have a look at UnitedHealth and what their medical care ratio has done from Q1 of 2024 to the latest report, Q1 of 2025. So this takes into account the drop in the profit margins of the company, and yet the medical care ratio went from 85.6 last year to only up to 86.4. That's a far cry from the 90% that we would need to see in United Healthcare Group, again, to justify what analysts are predicting. But that leads us to the last positive piece of news here in the video, which is about the change in CEO. So with the debacle of 2 CEOs ago, him getting ended, and then we had the one before that running away. So with the current CEO, Stephen Hemsley, coming in, let's just do a bit of a history of this guy just to see how good of a manager, a leader he could be for the stock. So we come here with some points from his Wikipedia page, because why not? So he's been involved with United Healthcare Group since 1997 in a senior finance position. He became COO, Chief Operating Officer, and President in 1999. And then finally in 2006, he became CEO. He was there for about 11 years as CEO, and then he became the Executive Chairman, which is more of a manager role of CEOs and COOs, all that business, and he's not directly involved in day-to-day operations. So this is a guy who's been involved with the company. Mr. Hemsley is probably the most trusted person to run United Healthcare Group. So this does add, or should add, a lot of confidence to investors, especially as well if we look at his amount of shares in United Healthcare Group. What you want to see is CEOs and managers, executives having a lot of shares invested directly in the company, because we want them to protect their profits, and then they would also protect us, the other investors. So Mr. Hemsley has $342 million invested in United Healthcare Group, and that would be as of the 16th of May, which is also the last time he made a transaction, which was a 7.9% increase on all of his shareholdings. So when he came into United Healthcare Group and after he took over, he added 7.9% on his position. So what we have here is the old but new CEO coming in, taking the reins. The negative case that is getting priced into the stock price is just extremely unlikely, and showing up the valuation picture, forward P ratio of United Healthcare Group, you can see this 20% profit drop expected per share in 2025. But assuming that does happen, even if the worst case scenario plays out, by the end of 2026, we're still looking at a forward P ratio of 11.75. And the thing is, even if all of those negatives take place, we're expecting around 17% earnings per share growth for the foreseeable future. What sort of valuation do you place on a company growing earnings per share 17%? Many other companies are priced at a 30p ratio in those cases, or a 25 at least. So my one little share I have, I'll be looking to sell that if the company has a giant resurgence in stock price in a short period of time. So giving it at least 2 years to get back into action. Often it might take a while to play out. So I have a stock price target of 672, or 119% price gain from today's levels. Now, what is that assuming? I'm actually assuming the worst case scenario in terms of the earnings per share picture. So again, even if we price in the worst of worst situations, but what I'm also assuming is the valuation, the P ratio of the company to recover to at least 22. Make sure you subscribe to this new channel and keep following the story. We're going to keep building that portfolio every week moving forward. See you guys next time. Bye.